In this video, I'm going to take you behind the scenes as a mortgage lender and show you how mortgage interest rates actually really work. How can you get the lowest interest rate? How can you get the best interest rate? And we'll address one of the most common misconceptions is that the lowest interest rate is the best rate. And that's not the case at all. So if you're in the market to buy a house or if you're a real estate agent, I think this will be very helpful to you so you understand. And I'll take you behind the scenes and we'll look at three different options. I'll show you an option with a rate at par, with 1 point, with 2 points, which option is better for you, which option should you choose, and how to look at it. And at the end, make sure you stick around all the way till the end, because one of the most important questions that you have to ask yourself before you make a decision on which rate to choose, you have to wait till the end, and I'll share that later. Are you excited? I am. Let's do this. First, I have a couple disclaimers before we go into this video. This video is not to show you what the current mortgage rates are doing today. It's early April. The rates already went up a little bit. We're already in the fives. But it's just the purpose of this video is to educate you on how the mortgage rates work. So I'll show you a couple of examples. The rates are a little bit higher right now. By the time you watch this video, they might be in the fives or sixes or threes. I'm not sure. I'm just going to show you what we see as a lender on the day when you actually are ready to lock in your interest rate, and breaking down on what makes sense for you and what's the best option. Okay, so the first disclaimer is that what I'm showing you, that this does not show what the current interest rates are doing. And secondly, this is only for education purposes, right? So the best way to learn is to look at an actual scenario. So the scenario that I'm presenting today in this video is a $527,000 purchase, 5% down, 30-year fixed conventional loan. The borrower has 790 credit scores or higher, well qualified, low back-end ratios, making a ton of money. Okay, so this is somebody who's super well qualified, putting 5% down. So we have the mortgage insurance on the 527 purchase. The mortgage insurance would be around, if they do 5% down, around $83. Again, 527 purchase, 5% down, and let's look at the interest rates. Okay, so when you call a lender and you say, what are your interest rates? This is what we see. So once we get some information from you and we put in all this information, price, credit scores, down payment, we get this screenshot over here. So we have a ton of different rates to choose from. So if you look at them carefully, let's look at the first thing, which is the interest rate at par. An interest rate at par, in this case, is 5%. Actually, with 5%, if we look to the left and then to the right, you'll see that it's a little bit above par. At par means at no cost to the borrower. So we should be looking at a rate that has 100. Okay, so this one, in this particular case, it looks like you would get $1,001 credit. It's just slightly above that 100 rate at par. And we can go lower on the interest rates and we can go higher on the interest rates, depending on what you're looking to do. And if you need help with closing costs, you can go higher on your interest rate. If you want to get a lower interest rate, you can always buy it down. So if we look at the interest rate, so someone who's purchasing a house, and putting 5% down and does not want to pay for the interest rate, in this particular case, we're looking at a 5% interest rate at par. Okay, the 4.875 is just slightly below that. It would cost you under $1,000. But let's say, and remember that rates change daily. They change every day. They change it up to 3 times a day. So I might be giving somebody a quote in the morning where we're looking at a 5% interest rate with $1,000 credit. And then later that afternoon, it might be, no credit, or it might be a little bit higher. So let's, in this case, again, educational video only, guys, right? Don't hold me to it. And so if we look at the 5% interest rate, we're looking at a 5.172 APR. APR stands for annual percentage rate, and that is your interest rate plus the closing costs reflected in an annual rate. I have a separate video if you want to check it out over here about APR and how it works and should you really look at it. But for compliance purposes, we have to disclose it. So 5% interest rate today would have an APR of 5.172 rate at par. Okay, so if we look at this particular case, 527 purchase, principal and interest would be around $2,687.60, plus the homeowner's insurance about $208.60, plus taxes $786, $83.44 for mortgage insurance. Your total monthly payment in this case, in this scenario, would be $3,765.64, and your total estimated funds needed for closing would be $29,500. 521.16. Okay, now let's look at the interest rate again. And this would be the rate at par. So if you're trying to save some money on your closing costs, this would be definitely an option. Let's call this option number one. And we'll come back to this in a second. So make sure you keep on watching. Let's look at option number two right now. So in option number two, let's look at buying down your interest rate with 1 point. This would be a 4.625 interest rate, and 1 point. We use common, it's terms that we use to make it more interesting, more complicated. Points, discounts, buy down. It's basically 1% of the loan amount. So depending on how much you borrow, 1 point for you in a $500,000 price range will be much higher than someone who's buying a house for 250, right? Because the 1 point is 1% of the loan amount that's being used to buy down the interest rate. And the numbers are not exactly to the point. In this particular case, 4.625 is actually 1.065. And in this case, if you wanted to go from 5% interest rate down to 4.625, you would have to pay 1.065, which is a percent from the loan amount. And that would come up to $5,332 in points in buy down. So you're basically increasing your closing costs to get a lower interest rate for the life of the loan. And we'll talk about the life of the loan later in this video too. But 4.625, that would have an APR of 4.885. This would cost you additional $5,331.92 in closing costs, but would lower your payment. If you look at the payments between option option one with the interest rate of 5, and we look at option number 2, the 4.625 would save you actually $113.56. That's how we have to look at it. It saves you $113.56 per month if you buy it down 1 point, and it would cost you $5,332. To see if this makes sense, we have to look at the break-even point, right? So we would take the cost on how much you are paying additionally at the closing table to lower your interest rate for the life of the loan. So $5,332, we would divide that by 113.56 and then divide that again by 12. That would give us 3.9 years break even. Okay, so keep that in mind, 3.9 years break even. So in this case, if you are planning on staying in the house longer than 3 years and 9 months, then it makes sense to buy down the interest rate. You wouldn't be really saving the first initial $113.56 per month because you paid $5,332 additional charges and points initially at closing. It's only once you hit this point, once you hit the break-even point, is when you start truly seeing a benefit of having a lower interest rate. So this would be the most common. A lot of times you'll see, because option number 1, the 5% interest rate, had the lowest cost with the higher rate. Option number 2 is the most common option. Once you break this down for a lot of clients and buyers, they usually look at the rate at par, 1 point, 2 points, and then they go, hey, I'm not sure on how long I will live in the house. So we'll go with something in the middle, and that's usually around 1 point. And this is what it looks like. So the 1 point in this case would cost $53.32 additional in closing costs, but would save you $113.56 per month. The break even is 3 years and 9 months. So if you plan on living in the house for longer than that, it makes sense to buy it down. If you plan on selling the house in 3 years, do not buy down the interest rate. It doesn't make sense. So you won't see those savings because you're paying extra at the closing table. So this is option number 2. The third option would be buying down the interest rate 2 points, and that would bring your rate down to 4.250. That's 4.25. So you could still buy down 2 points. You can still get a lower interest rate, but as you can see in this case, that it's also highlighted, 4.25, 4.250 would cost you 2.065, and that equals $10,000, 338. So $10,338 is how much you would have to pay additional at the closing table in order to lock in your interest rate at 4.25 for the life of the loan. With the 4.25 interest rate, we're looking at a 4.590 APR. Your total estimated payment would be around, with taxes and insurance, around $35.40.94, and your principal and interest would be $24.62.90. Okay, so let's take a look at this again. If we do the same analysis and compare it to option number 1, which is the rate at par, if we go from 4.25 and 5, so these are the two we're comparing now, okay? If you buy down your interest rate and change from 5 to 4.25, you would be saving about $224.70 per month. You're paying an extra 10 grand at the closing table, and you're saving $224.70 per month going forward. If you take 10,000 divided by 224.70 and then divide it again by 12, we're looking at 3.8 years break even. So again, in this case, your break even is 3.8 years break even. So if you plan, if you're going to sell the house before that time, don't buy down the interest rate. If you plan on keeping it for longer, then it will truly start being a benefit for you. But the break even point is 3.8 in this case. Okay, so if we look at this, these are the different options. As you can see, we also have different rates in between. So depending on your loan officer, whether you're working with me or someone else, you just make sure that they break this down for you and give you different options. You have to see which one of these is more beneficial to you. Do you have the funds to pay extra in points? Now, another quick bonus over here, we do have an option to also go up on the interest rate. So if you wanted to, let's say, get some credit towards closing costs, you can go higher on your interest rate. If you look at the rates over here, 5 would be at par. You could do, let's say, 5.25. That's a little bit more than half a point. So you would get a lender credit of $2,839. That's with 5.25. That can be applied towards your closing costs, escrows. So basically, you would be bringing $2,839 less to the closing table. You would get a lender credit for that amount if you were to lock in that higher interest rate. 5.5, for example, would get you 5 grand, $5,072 lender credit. In this case, again, this is a $527,000 purchase with 5% down. With someone who is well qualified. And so we basically have many, many different options. So when you call your loan officer, when you call a lender and start the conversation with what are your rates, that's really not the right way to start with it, because depending on, if you don't tell them and you're looking for the lowest interest rate, or what you see in the ads on TV, you see teaser rates, you're going to see the rates that have 2 or 3 points even sometimes. Okay, so that's not the right way to look at it. And rates change daily. There's about 17 different items that determine what rate you qualify for. And at the end of the day, lenders do not get paid on the interest rate. That's another thing that most people don't know. If you get a 3% rate or a 6% interest rate on the loan, the loan officer does not make a single penny less or more. They get paid the same amount. They don't get paid on the interest rate. They get paid on the loan amount after it's funded. So you always want to talk to a loan officer who can give you these different options. Make sure you have a conversation with them. Make sure they understand how long do you plan on staying and living in that house. And that's the ultimate one question that's most important in the entire process. Before you make a decision on which option is best for you, it's not just the lowest rate. In this case, 4.25 sounds better, but you're paying 10 grand extra for it, right? And if you're planning on living in the house for 5 years, it makes no sense. It's 10 grand. So for example, the ultimate question that you always have to ask yourself before you decide on which rate is best for you is to try to answer the question on how long do you plan on living in that house. If you know how long you plan on living in that house, you can look at this and make an educated decision, right? I know that some people look at it and say, hey, it's saving me $113 or $224. We're going to do, 360, 30 years. That's not how to look at it. Nobody stays in the same house for 30 years. If you're going to look at it between what most people stay in a house between 5 to 10 years, that's how you have to look at this. Okay. If you know you're going to stay in that house for 5 years, then make a decision, make an educated decision on that. Hey, I'm going to stay there for 5 years. Does it make sense to buy it down? What's my break-even point? And just take it from there. Okay, so when you talk to a good loan officer, a good local lender, they will give you these options. And if you don't get these options, then ask yourself, maybe that's not the best option for you as a lender. Make sure they take the time to educate you and explain how this works. Make sure they understand what your specific need. Okay, because the best rate for you might not be the lowest rate. In most cases, it's not. You have to look at, okay, what's your break even? How long will you stay in that house? And which one's better for you? Because, you have to understand that if you want to get a lower rate, it costs more. If you go with the higher rate, it costs less. So if you're a buyer and you're sensitive on, maybe you don't have too much money in the account and you're tight on the funds needed to close, then go with the higher interest rate. We're looking at April 2022. we're probably going to have a recession in the next year or two. And when we have recession, the real estate market does usually pretty well and interest rates drop. So if you're looking to buy a house now, when the rates are a little bit higher, you could buy it. You don't have to buy down the points and save that money. So for example, the 4.25, why pay 10 grand today, 2 points, if we know that the rates are going to drop in the next year or two, and then you can refinance. You can use that $10,000 that you would buy down today and use that later for your refinance, right? And if the rates are below 4.25, usually we want to see them at least 1% under what you currently have for it to be a benefit to refinance, then this would help you long term. So 2, 3, 5 years from now, you can have a much lower interest rate when you refinance. So I hope this helps you. Do me a favor, if you find this helpful, make sure you smash that like button. Make sure you subscribe. If you need to stop it and rewatch it, that's all good. Hopefully this sheds some light on how the mortgage rates actually work. And again, these rates are from last week. The rates today are already a little bit higher. And then depending on when you watch this video, the rates might be different. But in all cases, no matter what the rates are doing, we have something like this. We have the pricing. This is what the interest rates are doing at the time, which you qualify based on your ratios, your credit scores, your down payment, your DTI, and all the other things. And you can always ask your loan officer to give you a breakdown. Ask them to always give you 3 different options and see which one makes sense. So just remember that when you call a loan officer and you say, hey, what are your rates? I can get you whatever rate you want. You could see the rates on the screen. It's just a matter of, does it make sense for you? And so don't just ask for the lowest rate, because that's usually not your best rate. Thanks again for watching. Watch this video here, and I'll see you in the next video. And don't forget to subscribe. Thanks.